per share is the only financial ratio that is required to be reported under financial standards. The other ratios that we are going to study later together, they are not regulated by any standard. For example, the return on investment or return on equity or current ratio. There is no standard telling us how to calculate those ratios. Of course, there is a long tradition. There are many suggestions that we can use, and actually we rely on them to calculate good ratios, but there is no standard regulating those. The only one, it is the earnings per share, and we will explain why this ratio is so important as to has a dedicated and specified financial standard to regulate the way it is calculated and disclosed and represented in the financial statements. So, first of all, which are the learning objectives that we need to have covered by the end of today? First of all, we will define what are the basics earning per share. The abbreviation that we will use is this one over here. As we will see, there are two ways or two methods how to calculate earnings per share. The first one is the basic or the core earnings per share. That is, if we consider all the profit and all the shares that are outstanding to the common shareholders. And we will learn how to calculate the earnings per share in its basic version, in its basic form, according to the standards requirements. And then we will continue to define and learn how to calculate the other version or the other form of the earnings per share, which is the diluted one. Well, diluted earnings per share takes into consideration the dilutive effects of potential ordinary shares, which are dilutive securities, like for example options that could be converted to shares later, or convertible loan or convertible preferred shares. There are some specific securities that at a moment in a later time could be converted to ordinary shares and therefore could diminish the value and the worth of the shareholders themselves. Then if we consider this fact, if we consider or assume the conversion of the diluted potentially ordinary shares, what could be the difference or the usually decrease in value of the earnings per share? That is actually the diluted earning per share that we will learn to calculate today. The next objective is to describe the contents of the standard IS 33 on earnings per share. This is exactly IS 33. This is the standard that regulates and tells us how to calculate basic and diluted earnings per share. The contents, first of all, what are earnings per share as a ratio or as an indicator? What does it tell about the performance of the company? Why is it so important as to deserve a full standard for itself to be regulated? And why we don't have standards for other ratios, for example? So first of all, we will discuss about the importance of earnings per share. Then, as we said, we will jump on calculating basic earnings per share, and we will discuss also how the changes in equity shares during the year will be taken into consideration to calculate the number of weighted average outstanding shares during the year. To calculate earnings per share, as you might imply from its name, we divide earnings with the number of shares. Now, the figure of earnings may be very easy to find out because I have prepared the full income statement, and by the bottom of that statement, I may find the item of earnings. It's not the same thing with the number of outstanding shares. It's not as easy as it might think at first. We might think that, okay, it's easy, the number of outstanding shares is how many shares we have been issuing, but it should be a number that represents the average number of shares for the whole year. And consider that usually companies, they issue shares during the year, they retake or retrieve the shares from the stock market in the form of the treasury shares, if you remember. So there are a lot of movements in the share amount during the year, and that has has the effect of becoming difficult to calculate the number of equity shares during the year. And the standard provides really very specific and detailed guidance how to calculate the number of average outstanding shares. And we will also explain that. Next, we jump to the diluted earning per shares that takes into consideration not the issues or retrieval of ordinary shares from the market, but the potentially ordinary shares, which are dilutive securities, like options or warranties or preferred shares that could be converted at a certain moment in time in ordinary shares at a later date. Two other things that we need to discuss in this chapter today is how the earnings per share is affected in case we have a bonus issue or a rights issue. What are these two things that we will discuss today? Whenever we have in mind the structure of the shares for the potential shareholders, sometimes there are movements that are called like capitalization of shares, in case we issue new shares in the market. In case we issue new shares at a price which is below the normal price of the market, that is considered a rights issue. Whereas when we issue shares at no cost, at none of the having no money from our shareholders, that is known as a bonus issue. Both of them, bonus and rights issue, as they increase the number of shares, but they do not bring enough resources and funds within the company, they usually affect the earnings per share by generally decreasing this indicator. So we will discuss how we can account for this transaction known as bonus issue or rights issue during the lecture today. So let's start with the first topic, which is the importance of the earnings per share. Why is it important to discuss about this indicator, and why is it so important to calculate it really very carefully? As I said, this is the only ratio that you will find in the face of a financial statement. Go through the four financial statements: statement of financial position, the income statement, statement of cash flows that we explained yesterday, and statement of changes in equity and retained earnings. In four of these statements, there is only one financial ratio to be included there, and this is earnings per share. None of the other ratios is going to be included in the face of financial statements. Of course, companies make their own best to calculate and include and report financial ratios that makes them look good and have a good image, like they would proclaim that they have an increase in the return on equity and so on. But that is not required by the standards themselves. The only one that is required and is mandatory to be calculated in a thorough manner, in a very regulated manner, and to be included in the income statement is the earnings per share. Now, what it basically does is that it compares the earnings figure to the number of shares of the entity. When we consider the earnings that have been generated during a period, that would generally be an item of earnings or income that is attributable to the common shareholders. That means that when you have a look at the income statement, you remember that we have many levels of result or profit calculated there. We start with gross profit. Then a bit after that we have earnings before interest and taxation, EBIT. Then we have earnings before taxation. Then we have net earnings or net income. Now, which one of these earnings would be the proper item to compare with the number of shares out there? Now remember, the purpose of this indicator, of this ratio, is to calculate how much or which is the part of the earnings for the year that belongs to one share only. If you were a shareholder and you have one share of a certain company, and this company is declaring the earnings, which is the part of that earning that belongs to you, because you have one share of that company. So this is like a very simple explanation what this indicator, what this ratio means. So earnings per share should calculate and compare a figure of earnings that is appropriate or attributable is available to the common shareholders. Gross profit is not the right indicator, neither is EBIT or earning after taxes, but actually we usually take into consideration the figure of earnings after having distributed also the preferred dividend. This is the last item, probably, of the income statement that is available to the common shareholder. So after I have paid for everything, for every expenditure, and even after paying for the preferred dividend, the preferred shares are a very special class of shares. They have very specific features. They have some advantages. They are the first, they have priorities, and they are the first to receive dividends. That is, when I calculate the earnings per share, I should first take out and deduct the number of the preferred dividend, and what is left is available to the other common shareholders that we have. So basically, be careful which is the amount or the right figure of the earnings to include in the calculation of this indicator, earnings per share. Usually when we express the ratio, it is expressed in monetary units. For example, usually it is in cents, 25 cents per share or 50 cents per share. It depends on how large, how much it will actually, this figure and amount will be like. Remember, it's not in percentage, it's not in times, 2 times or 3 times, it's not 2% or 3%, but usually it is expressed in cents or monetary units. Actually, this figure should be reported by those entities that have ordinary shares publicly traded or are in the process of issuing shares. That is, earnings per share is not mandatory, is not required to be calculated by companies that are not quoted in stock markets. If they are not public, if they are not incorporated, if they are not selling shares in public stock exchanges, it is not a requirement for them to calculate and publish the amount of earnings per share. This is a requirement only for public companies, because these public companies intend to attract funds from public, from general investors. The general investors, they need to have very transparent information. And one very important piece of transparent information is earnings per share. In case I want to jump in and buy 1 share of this company, how much of the earnings of the last year would I get if I had purchased a share for the last week? This is like a very simple, again, explanation for what earning per share would mean to a simple potential investor. It is important sometimes, what the financial analysts usually do is that they are able to compare the earnings per share with the quoted price in the market. And then maybe you have previously read about this or encountered in the financial statements the PE figure, which is price to earnings. The price is the price of the share as we find it in the market. For example, if you go in Yahoo stocks today and check the prices of different shares and stocks for different companies, you would see the price of the share today in various stock markets, New York Stock Exchange or London Stock Exchange or Frankfurt and so on. Of course, there are differences in prices for the same company in different stock exchanges because the price is affected not only by the internal features of a company, but the price of the share in the market is affected by economics of demand and supply, and also the expectations of the investors and the special features of that stock market. So the price figure over here in this indicator, PE, the price figure is something that is depending on a special market, and it reflects usually the expectations and perspectives for the future on behalf of investors. The more I expect the company to be successful in the future, the more I'm available or ready to pay to purchase the price of that share or stock in that market. That is usually when we compare PE together, that is the price in the market compared to the actual earnings per share. This is like an indicator or a multiplicator that represents or it reflects the expectations of the market. How much more are you able or are you willing to pay in order to have a share? How much more than its earnings are you willing to pay to have this share? That is why P/E ratios are not only important indicators to analyze one company only, but sometimes they are also important and useful to compare companies to each other. We cannot compare companies through the price of share in market alone. We will see that some companies have a very high price in their shares and some of them a very low price, but what is a proper indicator to compare them to each other is the P/E ratio. That is, you calculate or you put in a ratio the price in the market to their earnings per share, which is usually found in financial statements, and then you can compare companies to each other. As I said, the P/E ratio, that is price of the share in the market divided by the earnings per share figure found in financial statements and regulated by IAS 33, the objective of lecture today. The P/E ratio gives an indication of the market expectation for the future of entities. Usually those companies that are expected to be successful and are expected to grow in the future, they are characterized by a higher P/E ratio than the others. That means investors are willing to pay more compared to their earnings in order to have one share of those companies. Okay, let's have some kind of comparison with figures here. It's an example that is also in the textbook, as you can see. We have two companies, X and Y. First company has a price per share, 150 cents. And the second company, its price per share, we can see it's 96 cents. Actually, we cannot, if we don't have earnings per share and P/E ratio in the last two rows, we cannot actually compare X and Y. The price per share over here, it's actually very different between them, but it doesn't say anything about the potential performance of the companies and also about their past performance. That means that the price is affected by so many factors that I cannot really consider the price only. The price is affected by the number of the shares that are issued, the demand on behalf of investors, and so on. What I'm trying to say is that the price usually reflects the features of the market. And there are many theories about the stock market: efficient market, non-efficient market, information asymmetry, and so on. So being based on price of the shares alone is not a good indicator about how successful a company is or is not. Therefore, we have to find another indicator that mixes what the market sees in a company, what value the market puts in a certain company, with what that company really is worth. And this is the P/E ratio. Basically, what we do here is that we divide the price with the earnings per share. Again, earnings per share is to be found in the financial statement. Is a figure that the companies have calculated. You don't have to do the calculations, you just take them ready from the financial statements. And when you compare, you have the P/E ratio over here. Now you see that the X company, even though they have a higher price, company X has a higher price than Y, actually the P/E ratio is lower than the second company. What does that mean? For the X company, a potential investor is willing to pay only 7.5 times more than the earnings per share of this company. Whereas for the Y company, there are greater expectations. It is deemed to be more successful, and investors are willing to pay up to 12 times more than the earnings it generated last year. So again, the P/E ratio compares the price in the market to the earnings per share that the company recorded. And it says how much more the investors are willing to pay for one share compared to the earnings that they reported and declared. That is that company X is under, usually these terms are being used. Company X is undervalued compared to company Y, which is overvalued. So company Y is considered or expected to be more profitable. Now again, these are expectations. When the future comes, it does not mean that actually, currently, company Y is going really to be more successful than company X. These are just the expectations that the market builds and rouses around certain companies, okay? So P ratio is useful to measure the general perception of the public in a market and to compare this between them. Okay, I don't know if that is clear, how we can use earnings per share in order to make companies comparable to each other. Of course, be aware and be very careful how you use the P ratio, this indicator, because, okay, earnings per share are a very accurate and correct ratio. It is being calculated based on an accounting standard, IAS 33, but the price per share is not. It is subject to different actions on behalf of the company, on behalf of investor. Sometimes there are many speculative actions, many speculations over there, with the only intention to put a pressure in the price and to artificially put it up or put it down. So beware on using, of course, the price, because sometimes it's not reflecting the reality, what's really going on within a company. But still it is a useful measure to compare companies together. Yes?
But
a question?
If the price is decided by the market, if we use the ratio himself can be not correct because the price can go up based on how much investors buy or stuff like that.
That is correct, and that is what I'm trying to say over here. So if we use the price of the share, usually the price is not a very clear figure. It has these speculative effects in it. Then again, I have to mention here, we have many theories in finance that probably you are going to discuss later in these studies. It is speculated that the stock market may be inefficient because of information asymmetry. That means that some of the investors that try to buy shares, they are not really informed about what's going on in the company. They watch the stock trends and they buy whatever stock is going up. Okay, you do the same if you didn't have some economics background. Many investors do this, and these are considered to be inefficient stock markets. That is, information asymmetry exists there. But usually in the recent years, with the increase and improvement in the regulation for financial and disclosure and accounting reporting, actually what it is observed is that the stock markets are becoming increasingly more efficient. That is, the prices of the shares are actually reflecting the inner features of the operations of the company. That means that the efforts to regulate accounting and financial reporting, I mean all these standards that we are discussing together, these are not just to make our lives really boring. They are there to regulate the stock markets, to increase the quality of financial information so the investors can take better decisions. How is that possible? That is possible because the information is more qualitative. You take decision not based only on the stock trend or the prices are going up or down, but actually you base your decisions on what financial statements are saying. Yet again, we cannot deny that the markets sometimes are emotive, and people are usually taking decision based on their emotions and their feelings, not actually their real calculation and analysis of the market. So it is something that we cannot deny. The trend and the desire is to increase the market efficiency in order that the price of the shares will really reflect the inner features and characteristics of the companies, but still, investors are humans, are emotional beings, and sometimes their decisions are not rational at all. They are pushed, or they have incentives that are not really connected with sound financial statement analysis and so on. I don't know if it was an answer to your question, but at least we had the possibility to discuss about why P/E ratio is not a perfect one, a perfect indicator, but still it's a good possibility to compare companies to each other. And here I have mentioned something. P/E ratio is not perfect, but as it belongs to two companies, X and Y, that are quoted in the same stock market, it means that they are affected by the same features of stock market inefficiency. That means that if we are based in the same stock market and we compare two companies from this market to each other, there are the same factors that affect them both, the prices of them. So it's like this is more useful, and we can use the P/E ratio to compare them if they are coming from the same market. Again, this is just to emphasize the importance of the earnings per share. Wherever you go and read some article on financial analysis, you would inevitably be encountering the P/E ratio. It is almost always used to analyze companies and to compare companies with each other. But please, use that with caution. It is not perfect, because the price is affected by irrational decisions sometimes from the investors, and we have to take that into consideration. Even with the greatest efforts of recent years to improve the financial information quality, it still is something to be discussed. Investors are humans, and their decisions sometimes are emotional and not rational. So we have to take that into account as well. Okay, we discussed how we can use earnings per share in the P/E ratio, which is really very useful. We will again discuss about the P/E ratio at a later lecture that we'll share together, that will focus on the financial indicators, financial ratios. This was just to make you aware of the importance of the earnings per share itself. So what does IAS 33 specifically requires for this indicator, for the earnings per share? First of all, it should be included on the face of the profit and loss statement. That means that I should not find it somewhere hidden in the notes that are 100 pages long, but it should be there at the bottom of the income statement, of the profit and loss statement. Usually in the notes you will find disclosure, further information, how the earning per share has been calculated, but not the figure itself. The figure itself is right there in the profit and loss statement. Actually, the earnings per share could be both basic and diluted. Usually the companies will calculate and report both of them. So you will have the possibility to find both of these indicators in the income statement. By definition, and this is such a long sentence actually, the basic earnings per share represents the amount that is attributable or available to the ordinary shareholders by dividing the earnings figure, and we will later mention specifically what the earnings figure is, by the weighted average number of ordinary shares outstanding during the period. That is, in the ratio that we are going to calculate, earnings are going to be the numerator, the figure above, and the denominator are going to be the weighted average number of ordinary shares, so the figure in the below part of the ratio. Diluted earnings per share accounts for any dilutive security. Usually they are called POS, potentially ordinary share. They are not ordinary share now that we are talking, but they can be in the future days. When we prepare the statement of financial position as of 31st of December 2021, we may have options or convertible bonds. And who knows, maybe during 2022, they can be converted in ordinary shares. Now, what are options? Just to be clear, we are speaking the same language. Have you heard what options are? They are securities. Companies usually issue, of course, shares and bonds, but also some other securities more specific like options, for example, futures, forwards. I'm not touching upon them because it's become complicated, but at least we need to know what options are because it affects our understanding for this chapter. Any idea about options with your own words? How you understand these options?
It's the option to buy or sell the share in this case at a date that is established at the day of the contract.
And that is correct. I'm repeating for the students online. Option is a security that gives the holder the opportunity or the potential to convert the option into ordinary share in a future date at a preferred price. That means that the option gives you, if you are holding that option, it gives you the opportunity to buy ordinary share at a price lower than the market. And that is known as the execution price of the option. Usually the option holders will execute the option they are holding if the price in the option is lower than the price in the market. Okay? But if the price of the option is higher than the price in the market, they will not execute that. And that means that if the company has issued some option, it depends on the fluctuation of the price in the market if the option holders will execute the options or not. And to summarize all this sentence, if there are options in issue, we are not sure if they will be converted in ordinary shares or not. Why? Because this depends on the fluctuations, on the variations of the prices of the shares in the market. So basically, options are securities that gives to their holder the right to purchase ordinary shares from company at a lower than market price. Will it be executed actually in the future? It may be. It may have a maturity date for 1 year, 2 years, and so on. We don't know that, but will it actually be executed? That depends on many factors. Which the most important one is the price share in the market. So options are one potentially ordinary share. They are not ordinary share yet, but they can potentially become in the future. Now, when I calculate the earnings per share, I should take into account the possibility that the position of the current common shareholders may be diluted or impacted by these option holders that they may come and join and purchase ordinary shares of the company. That is the dilutive effect of options. Suddenly, other people may become shareholders. They can convert and execute their options into common shares, so they are increasing the number of the shareholders. Remember, the shareholders are the owners. The more shareholders are in the company, the less part in the earnings I will have as a specific shareholder. Okay, that was option. What about convertible bonds? That might be easier to understand. Bonds are credit security. When the company has issued some bond, it has collected money. Bonds usually have a maturity date in the future. That means that the company will need to repay the bond. But some of the bonds may have a special feature, a special option attached to them, and that is the possibility to be converted in ordinary share. That means that whoever is holding these bonds in a certain moment, they can decide to convert the bond into an ordinary share. So they are not bond holders anymore, but they will become shareholders. Do all the bonds have these features? Not all of them, but when we want to make the bonds and debentures really attractive and sell them fast in the market, sometimes we attach this special characteristic. We add this feature. They are convertible. Every time you want not only to take the interest from the bond, but you want actually to become a shareholder, you can convert them at any time. So probably when you check the financial structure of companies and you see that there are convertible bonds there, that means that sometime in the future, some of these bondholders, maybe not all of them, but some of them, they may decide to convert their securities from bonds to common shares or common stock, and that would increase the number of the shareholders, again causing the dilutive effect that we are talking about. The more shareholders come in the company, the less earning will be available for all of them, okay? So this is why companies, in order to be very transparent with the potential earnings that they are reporting, they have to calculate the basic earnings per share, which is based only on the number of current existing ordinary share, but then they have to take into account this potentially ordinary share, convertible bonds, convertible preferred shares, options and warranties and so on. If you have issued them, you have to take them into account as if they will be executed, all of them. So not partly, not with a certain percentage, but as we will see, we will assume that all of them are going to be converted into common shares. Okay, let's see a very simple example over here. All the examples that are included in the slides, and I'm not going to solve with Excel, they are all part of examples in the textbook. So this is the reason why I'm not stopping and illustrating the solution through Excel. Later we will have another example in Excel spreadsheet. Now we have this data about the company. We have the profit before taxation over here. Then the figure of taxation that includes also the deferred adjustments, that is current taxes and deferred taxes both. Remember that when we mentioned the effects of taxation, we said that sometimes we have to take into consideration not only current taxes, but in case companies have also the deferred taxation. Where is the deferred taxation to be found? Usually it will be part of assets or liabilities, both alike. It depends on the reason it has been generated. So if profit before taxation is 1 million euro, and the taxation is 400,000, that means that the profit, net profit for the year is 600,000 euro. We see here that we have preference dividend 50,000 and the ordinary dividend 100,000. I apologize for the zeros that have been displaced, but I guess that's not a big issue, right? Or we can fix it now, but if it's not a big issue, we can go on. So what we see here is that when we deduct from the profit of the year, which is 100,000, when we deduct the preference dividend and the ordinary dividend, both of them, the amount, the sum of both of them is 150,000, then we are left with a retained earnings profit. Be careful, I'm not saying that this is the figure of the earning that we will use for the purposes of the calculation, but the retained earnings for the period is 450,000. The requirement is actually very simple. Calculate the basic earnings per share if there are 200,000 ordinary shares in issue. Now, usually this is the structure of the information that is provided every time we are required to calculate earnings per share. Usually, questions and exercises are very similar to each other, and usually you will find the same data. Profit before taxation, taxation, profit after taxation, dividends, careful, dividends are related to preferred and ordinary shares, and then number of shares. In this case, the number of shares is provided for us. In other instances, we have to calculate the number of shares. So for the moment, we are starting with simple calculations. So how do we calculate the basic earnings per share in this instance? Remember that the basic earning per share is the ratio, as the name implies, the ratio of the earnings with the number of ordinary shares. Now, let's make some clarification. The first one that you need to know is what figure of earning, which one would be taken into consideration for the purposes of putting in this ratio. Now, as you can see, the figure of earnings is the profit after tax and the preference dividend. Remember that the figure of earnings that I should put in the numerator of earnings per share is the profit attributable to the common shareholders. That is, usually it will be the profit of the year minus the preferred dividend. Okay, so maybe you want to write that down. Profit of the year minus the preferred dividend, but not minus the ordinary dividend. Why? The ordinary dividend is already available to common shareholders. So this is something that they are going to have later. What I need to compare with each other, there is the earnings that is available to the common shareholders, and the figure of the earnings is profit of the year after I take into account the preferred dividend, which is going to be distributed to the preferred shareholders. So preferred dividend will be distributed to preferred shareholders. What is left is the amount of profit available to common shareholders. That is 600,000 profit of the year less 50,000, which is the preferred dividend. This is compared with the number of ordinary shares, 200,000. This gives us a basic earning per share, as you can see expressed in monetary units, as we mentioned, 2.75 euro per share. That means that for each share that the company has outstanding, has issued, the figure of earnings that potentially belong to each of the share is 2.75 euro. Was this calculation clear? Do we need to explain it again? Something to keep in mind here and to take away from this slide, please. Keep in mind the figure of the earning to be compared with the number of shares is always the earning attributable to common shareholders. Usually, it will be profit of the year less preferred dividend. That is, profit of the year less preferred dividend. Even though sometimes it's not easily provided, we can, I think, easily calculate having this formula, profit of the year less preferred dividend. Okay, something else that we need to calculate, sometimes you will see that during the calculations of earnings per share, the biggest problems in this formula arise not with the earnings figure. Actually, the biggest problems arise how to correctly account for the number of the shares outstanding. Now, you think that is something easy to calculate, but it's not actually. And a very considerable part of IS 33, too many paragraphs there, provide detailed guidance on how to properly account for the weighted average number of shares in issue or shares outstanding. Now, you see, in our example over here, we didn't even go there. We just assumed that the number of shares was 200,000. We didn't mention any probable problem of dealing with this number of shares. But actually, in reality, the biggest problems that arise are how to properly account for the number of shares, taking into consideration that you issue and reissue and then retrieve from the market many times during the year. So the number of shares really changes a lot. It evolves. It's not a static or constant figure. So what does IS 33 says about the changes in equity share during the year? First of all, the number of ordinary shares should be the weighted average number of ordinary shares outstanding during the period. That means that I should not take the number of shares at 1st of January, at 1st of July, or 31st of December. Neither can I take into account a simple average number of shares, like how many shares do I have at 1st of January, plus shares at 31st of December, divided by 2. That is a simple average. No. The standard requires us to take into account a weighted average. A weighted average means that I have to account not only for the number of shares, but also for the number of months they have been outstanding. The longer they are in issue, the more they will have an impact in calculating the weighted average. That means it's not a simple arithmetical average, it's a weighted average, taking into account the period for which they have been in issue. The longer, the higher is their impact in calculating the weighted average. So what I simply said is also explained there. This is the number of ordinary shares outstanding at the beginning of the period, adjusted by the number of shares bought back or issued during the period, multiplied by a time weighting factor. To put it simply, if you issue shares on, I am assuming 1st of July, that is that these new shares that you issue at mid-year will be accounted only for half year, because they will be in issue for 6 months only, from 1st of July until 31st of December. So issues made during the year will not be accounted for a full factor, full weighting factor for a full year, but only for half year in this case. Or if you are issuing shares, for example, in 1st of November, they will be in issue only for 2 months, November and December. And when you take into account their number, you will weight that with a factor which is equal with 2 months divided by 12 months, that is a full year. Again, I'm repeating, this means that we have to take into account the number of new issues or retrievals from the market, but also the time when this happens, by weighting that with a proper factor. Time, it is known as a time weighting factor. The time weighting factor, explained over here, is the number of days that the shares are outstanding as a proportion of the total number of days in the period. Usually the time weighting factor could be represented like 180 days to 360. 360 is a full year. 180 days are 6 months. But you may also use the number of months to put it simply and to have more simple calculations. Okay, so let's have another example how to calculate the earnings per share taking into account the change in the number of shares outstanding during the year. In this example that you will see here, we will assume that the problem is not related to the earnings figure, but the biggest problem during the calculation would be the correct calculation of the number of shares, weighted average outstanding number of shares. This company, Fulmer Public Limited Company, had issued share capital on 31st of December as follows. 500,000 preferred shares, their value is €1 each, and they have attached a preference dividend of 7%. Usually the preferred shares, I think we covered this together in a previous lecture. The preferred shares have some special features. They have priority in dividend distribution. And usually before we distribute common dividends, we have to distribute the preferred dividends. In this case, we have this number of preferred shares. Their value is €1 each, and the attached dividend is 7%. Now the dividend 7% is calculated on their value. That is 7% of €1. That is each of the preferred shares. Then in the financial structure, we also find some ordinary shares. The number of ordinary shares at 31st of December, or otherwise at the beginning of the period, it is 4 million ordinary shares with a value of €0.25 each. That is 25 cents for each of the ordinary shares. Profit after tax for the year ended 31st of December was €435. Remember, this is profit after taxes. That doesn't mean that this is the profit attributable to common shareholders. Why not? As I have preferred shares over here, first of all, I need to take into account the preferred dividend, and what is left is the earnings attributable to common shareholders. Okay, so be careful, profit after taxes is not the figure that you should really jump and take and include in the calculations. First of all, whenever you see that you have preferred dividend over there, take it out first. And what is left is the earnings to be used. Something that we explained even before. Okay, now this is the new thing in this example. On 1st of October, that means 3 months before the end of the period, October, November, and December, the company issued 1 million ordinary shares at full market price. Now, again, things are not getting too complicated, not yet, because, okay, I'm issuing new shares, but I am applying the market price over here, which is 25 cents. In case we issue new shares at a price that is below the market price, we will see later, they are considered rights issue. Okay, so later on, we'll have the chance to see what happens when we issue new shares at market price, below the market price, and they are considered a rights issue. But for the moment, let's assume the issue will be at full market price. Okay, now that we know that these are ordinary shares issued in an ordinary fashion at full market price, we are required to calculate the basic earnings per share for the current year 2025 that is over there. Okay, so let's first of all write the formula over here. In order to calculate the basic earnings per share, I need two figures, right? Don't be intimidated by all the figures that are in there. We're going through that step by step. In order to calculate earnings per share, right here at the end, I need basically two things. First, earnings that are available to shareholders, okay? This is the numerator, the figure above in the ratio. And then something else that I need is the number of shares, weighted average, taking into consideration the time period they have been in issue, okay? And that is the denominator in the ratio, the figure that is below the line, okay? So step by step again. Let's start with the earnings. The earnings are an amount that is considering, as we said, what part of the profit is really attributable or belongs to common shareholder. Now, we start with a profit after taxes, 435, right? But this does not mean that all this amount of profit is available to my common shareholders. I have to do something first. What? Due to the features of preferred shares, first I have to pay them the dividend that they have the right to have, and then what is left is for my common shareholders. So again, there are two classes of shares. Preferred shareholders or preferred shares, they have priority. Before I give everything I have to my common shareholders, I have to give the dividend or what belongs to the preferred shareholder. Now, what belongs to them? If we make the calculations based on this, we have 500,000 preference shares at €1 each, and the dividend is 7%. Basically, it is 500,000 multiplied by 7%, it is €35,000. That means that out of this profit after taxes, if we subtract the amount of preferred dividends, €35,000, the profit attributable to common shareholders is 400,000. Do you have this calculation in the slides? I think it is there, right? Okay. It's over here, right at the bottom, like we explained before. So profit before taxes, less the preferred dividend, €35 again, you can write it there. It is the amount of the preferred shares, 500,000, multiplied by 7%, which is their dividend. Okay, earnings, it's easy. At least it's easier than calculating the number of shares. Now, how do I come up with these 3,250 shares in issue? You see the number of shares that is the denominator of the earnings per share figure? How do we come up with this value? There are two ways to calculate that, and both of them are here represented. You can use either of them. Whatever you decide to use in your calculations, you will be right. The standard allows them both. Now, let me explain what each of them means. Again, we have to take into account the new issues of shares, but also considering the period of time they have been in issue, okay? Have a look again at the data because it's important. We start the year with 4 million ordinary shares, right? 4 million are at the beginning of the period. Then we issue 1 million ordinary shares by the end of the year, 3 months before the year ends. Now, how we calculate? I think there is a lapsus here, right? Yes. Sorry, just a moment. Okay. Okay, it's okay. I thought it was, I read it by mistake. I thought it was an error, but it's not. We have 4 million ordinary shares. Please, this is something that you can get confused as well, like me now. The data here belongs to end of the year, not beginning of the year, like I previously thought. So 4 million ordinary shares are outstanding at 31st of December. I don't know how many shares were at the beginning of the year, but I know that 3 months before the end of the year, we issued 1 million ordinary shares. Now, by common logic, I would say that we started the year with 3 million shares. We issue by the end in October 1 other million shares. And at the end, I read it by mistake the year here because this does not let me. By the end of the year, we have 4 million ordinary shares. Okay, so this is like the chronology of events that has been happening. We start with 3 million in 1st of January. Until 1st of October, we are only having 3 million shares outstanding. At 1st of October, we issue 1 other million, and then until the end, we are having 4 million shares outstanding. How can we compute or calculate the weighted average? The first way is to consider how many issues we have in circulation or outstanding for the exact number of months. As I explained it right now, we had 3 million shares for 9 months. That is from 1st of January until the end of September or the beginning of October is the same thing. For 9 months of the year, we are having 3 million shares in issue, right? So this 3 million is going to be weighted with the time factor, which represents the number of days or number of months. It's the same thing. In this case, it is 9 months divided by 12 months over here. Again, why do we do that? Because 3 million shares have been outstanding for 9 months only, not for the full year. Why not? Because starting from 1st of October, for other 3 months, I don't have 3 million outstanding anymore. I have 4 million because I issued another 1 million shares. So one way to calculate the weighted average number of shares is to consider the opening balance of shares, number of shares, which is 3 million, and to weight it with the appropriate time factor, which is 9 months out of 12 months of the year. And then consider the ending balance of the shares, which is 4 million, and to weight it against the time factor, which is, in this case is 3 months. And we have the total number of weighted number of shares, 3,250,000. The same exact result will be derived if you follow the other way of calculating. Now this is also basically it's the same thing, but another way to look at the reality. You would say in this case that the 3 million shares you've had from the beginning to the end. So you start with 3 million shares, and until the end of the year, they are still there, outstanding, in issue. They have not been retrieved or taken back, okay? So these 3 million shares that you start with are existing or are outstanding, are in issue for the full year. That is why you multiply 3 million shares with 12 by 12. That is for the full year. They are up there. But the new shares that you are issuing, these 1 million shares that you issue on 1st of October, is circulating, is in issue or outstanding only for 3 months. They are issued in 1st of October and until 31st of December. That is 3 to 12 months. Again, if you calculate the weighted average number of shares, it's the same amount or the same number. You can follow either one of these calculation methods and you will have the same result. Then after you have calculated the earnings that are attributable or available to common shareholders, we explained how we did that, and we got this amount here, 400,000. When you divide that with the number of weighted average number of shares, we get the earnings per share figure, in this case 12.3 cents per share. Okay? Any question? Okay, we make like 5 minutes break and you again have a look on that and decide if you want to ask about anything. So we can continue. I think so far so good. Maybe I'm happy to see you laughing. The weekend is ahead. Do not do or do not study anything this weekend, okay? The week has been enough tough for everybody, so this weekend just have some rest. Okay, you may think of IGA but not study. When we meet each other on Monday, we'll make a plan how to proceed with the next week, okay? So again, let's focus in the next 2 hours to understand what's going on. Otherwise, we will not be able to solve the exercises with earnings per share. We have just started. This is the beginning of the road. To calculate the number of weighted average shares, we still have to learn about diluted earning per share, rights issue, bonus issue. That is not easy, okay? So, brace yourself and let's go on. Now, what happens when we issue shares not at the market value? I mentioned even before that when we issue some shares at the market value, nothing changes in the position of the shareholders because the new shares that are joining the company, in the previous example there were like 1 million new shares, they are entering associated with some resources coming in. So of course I'm increasing the number of shares, but as I'm selling these shares with the market of the price, the resources are also coming in the company, okay? But what if I issue some shares at below the market price? Can that happen after all? And if that happens, what can be the motive behind that? Well, sometimes it is practiced by many companies, and so we have to take into consideration, in case we sell new shares but at a low price, what will this cause to the earnings per share? Obviously, if you may think about that, if you were the investor of a company, a shareholder of the company, you would not be very much pleased and content to know that new shareholders are joining in, paying less than you have paid, and still sharing the same amount of earnings as you are, for being there for a longer time and for paying more to get in the company. So on the perspective of current or existing shareholders, joining or taking new shareholders by offering shares with a lower price, it's not something usually that makes them pleased or content. And that is why sometimes companies, when they sell shares at a lower price, first of all, they offer these new shares to the existing shareholders. If you want to buy them, okay. If you don't buy the new shares with a lower price, then they are sold to the outer market, to the new shareholders. Okay, I said that. Shares may be issued without a corresponding change in resources. For example, there are 4 cases or 4 possible situation that may happen. For example, we can have what we know as a stock dividend, that is also known as capitalization or bonus issue. The name that we are going to use in this chapter is a bonus issue, but we have been mentioning in other lectures before, between us, we mentioned that as a stock dividend. Probably at the cash flow statement chapter, when we talked about the cash dividend, we said that, okay, dividend paid in cash is part of the cash flow statement under cash flows from financing and so on. If the dividend is paid in stock, that means that it's not part of the cash flow statement, but still it's going to be represented in other financial statements. The term that we are using here in this chapter for a stock dividend, it is bonus issue. Basically, what a stock dividend is a issue of new shares to the existing shareholders for free. You don't have liquidity, you don't have cash to pay dividends to the existing shareholders. Instead, you give them new shares for free, and you don't make them pay anything. Basically, this is a simple explanation what a bonus issue or a stock dividend is. Again, we are coming back and showing all the details, but just to represent this kind of situation. Another example may be a share split. A share split is the case when ordinary shares are issued to existing shareholders for no additional consideration. Instead of issuing a stock dividend, sometimes the share split happens when the company may judge that the price of the share in the market is too high for one share only, and what they do, they make a share split, like one stock is going to be split in two parts. So one pre-existing share will be equal with two new shares. Nothing changes in the cash position of the company or the shareholders. Only the number of the total outstanding shares will be increased. And why does that happen? Usually to lower, artificially lower, the price of the share in the market. Usually this is happening in those periods when the company judges that the price of the share in the market is too high, and they apply a share split. Again, nothing changes in the position of an individual shareholder. Proportionally, they have the same part in the company. They are having more shares. Instead of one, they have two, for example. But proportionally, compared to other shareholders, they are still in the same position. Again, this changes, or at least it aims to change the price of the share in the market. Another situation is when we issue to existing shareholders some shares with a price which is lower than the market price. This is the situation that I mentioned before. Sometimes we want to offer to our existing shareholders what is known as a rights issue. So we sell to our existing shareholders shares but with a lower than market price. Usually this is done to increase the resources by selling some shares, but still, as they are being sold at a lower price than I would normally offer in the market, the corresponding increase in resources is lower than it should be, and it usually causes a decrease in the earnings per share. So again, all these movements, all these transactions over there, they have an impact in earnings per share because usually they increase the number of shares by not causing anything or causing something really very small to the earnings figure. Remember, earnings per share is the ratio between earnings and shares. If you increase shares but earnings are the same, earnings per share will decline. So everything that we are covering there are transactions that will cause the earnings per share to diminish, to decrease over the time. And the last thing is a reverse share split. That is something that usually increases earnings per share, the difference, because it is the reverse of a share split considered over here. It is sometimes a consolidation of shares. That is, if you are holding two shares, they will be consolidated in one. So this is a reverse share split. It usually reduces the number of shares outstanding, but of course without a corresponding reduction in resources. That means that in the ratio of earnings per share, earnings will not change, whereas the number of shares will be reduced, and that is the only situation when the earnings per share will increase. What we are going to discuss in detail in the rest of this hour is two things. First of all, bonus issue and then rights issue. Bonus issue is the case when we are offering some stock dividend to our existing shareholders. That means that I want to pay them the dividend, but I don't have any cash. And instead, I offer them some stock, some new shares. Their proportionate position does not change in relation to each other or to the company. They still will have the same relative position, but they will own more stock or more shares after this movement. So, in a detailed manner, what is a bonus issue? Ordinary shares, as we said, are issued to existing shareholders for no additional consideration. That means we are not receiving any money as the company. We are issuing the shares to common existing shareholders, and no money is coming in the company. That means that the number of ordinary shares outstanding is increased without an increase in resources. No money is coming in. That means that if I'm not receiving any new funds, probably the earnings will be the same, will not be impacted. But the number of shares, as I said, is increasing, so that means that earnings per share will be reduced. Okay? Now the problem is that is simple to understand and comprehend, but IAS 33 has a paragraph that requires for this event to be treated in a retrospective manner. If you know what the retrospective manner means, that if you issue some shares at a certain moment in the current period, you will assume like this has happened. You will assume like this has happened at the earliest period that you are reporting from. So the number of ordinary shares before the event is adjusted for the change as if the event had occurred at the beginning of the earliest period presented. Let me explain simply. If we issue a bonus, what is the day today? If we issue a bonus at 22nd of October 2021, and we prepare the financial statements for 2021, we should recalculate the earnings per share, of course, for 2021, but also for 2020. So, as we prepare financial statements for the last two periods, 2021 and the previous year, 2020, the standard requires us to take the bonus issue as far in the past as we can. This is the retrospective adjustment requirement of IAS 33.
How far?
Earliest period presented. Usually the financial statements are required to be presented for 2 consecutive years. That is, the financial statements for 2021 will include those of 2020. If you have traditionally been reporting financial statements for 3 years, well, that's your cost. You have to go back 3 years because you represent information for 3 years. But usually companies, you have seen probably in your group work projects, usually they use 2 years to represent information. Okay, so remember, bonus issue is not something complicated to understand, but it is this requirement that takes us back into the past and readjust the figures of the earnings per share in the past that really causes the trouble here and makes us recalculate earnings per share even for the previous year. Okay? Now, why the IAS 33 requires that? You know that there are some requirements in the financial reporting standards that are required to be reported in retrospective. So to adjust the past as if this transaction has always happened. So to see how the position of the investors could have been in 2020 if this bonus issue would have happened in that past period. Just for comparative reasons, okay? For having comparable information. Okay. This is, as a summarized result, the earning per share figure for the previous reported year should also be restated. Let's have a short example that illustrates the bonus issue. We have the same company as before. They have issued share capital in this manner over here. So the same example as before. Nothing has changed. Except that on October 25, they have issued 1 million ordinary shares at full market price as a capitalization, as a bonus issue. That means that these 1 million ordinary shares that we issue in October right now are not issued for cash, but are issued as a bonus or for no cash consideration. This is the only difference from the above relating or compared to the above example that we saw in the previous hour. This means that we now have a bonus issue, okay, for no additional consideration. Now, if we issue 1 million shares, having 3 millions before issue, this means that we have issued 1 new share for each 3 existing. Can you relate to this rule? Please, this is important. Again, if we have 3 million shares outstanding, and we decide to issue 1 more million as bonus issue, this means that I'm issuing 1 new share for each 3 existing. This ratio has its own importance in the calculations. So the ratio for issuing the bonus is 1 to 3 existing shares. We are required, of course, to calculate the basic earning per share for the year that is represented here. In this example, we are not going back in the previous year to recalculate because we have the data for 1 year only, but we will still show how to make the calculations for the bonus issue. Okay, so we assume that 4 million shares are in issue for the whole year. That means that we have issued 1 million new shares. The number of the shares in issue can be calculated in this manner over here. What changes related or compared to the previous calculation is that we apply what we know, and it is important to learn as a new concept, a bonus factor or a bonus fraction. Now you see that the bonus factor over here, it is 4 to 3. The bonus fraction is the ratio between the number of new shares to the number of existing shares before the bonus was issued. Again, what a bonus factor is, or what a bonus fraction is, remember, is the ratio between the number of shares after the issue to the number of shares before the bonus issue. After the bonus issue, we have 4 million shares. Before, prior to the bonus issue, we used to have 3 million. That is 4 million compared to 3 million. That is the bonus fraction 4 to 3. And now you see what we do. We consider that these 3 million shares before the bonus issue, okay, they are weighted with a time factor, 9 to 12 months. We understand why we do that. But they are also multiplied with a bonus fraction, which is 4 to 3. This is done with the purpose to take the bonus issue as back in the past as possible. Again, the application of the bonus factor or the bonus fraction to the number of shares existing before the bonus issue has the intention to take the bonus issue as far in the past as possible, because this is required by the standard, as we said. Now, not surprisingly, when you do the calculations over here, when you complete all the data and calculation, you will find that the number of shares, weighted average number of shares after the bonus issue, is 4 million shares. Okay, so please allow me to be more direct. To put it simply, the IS 33 says that when you issue a bonus, you should assume that this bonus has been in issue since the 1st of January. That means that you start with 3 million, you issue 1 million bonus in October, but you assume that this 1 million has been in issue since 1st of January. So in other simple words, since 1st of January, you've had 4 million shares in issue, okay? To say it really very simply, without these complicated calculations here, and somebody of you may say, okay, why do we need that for? If we assume just simply that whenever we issue the bonus, being it October, July, doesn't matter, I will just go back from since 1st of January, okay, that's simple then. If we issue 1 million new shares, and I take that back to 1st of January, that means that for the whole year, from 1st January to 31st of December, we have 4 million shares in issue. We all can get that, right? We arrive at the same figure by applying this equation over here, and somebody may think, okay, why do we even need that for? Why do we need to make all these complicated calculations? And why do we need to introduce a new concept known as bonus factor? In order to arrive to a number of shares that I logically can think of. Okay, I'm issuing some new shares. Even if I issue them at 31st of December, I will take that back since the beginning of the period, right? Now, how and why do we represent and introduce the bonus factor? The idea of bonus factor is very important to apply and restate the earnings per share figure for the previous year. In case we had the data for this company, not for 2025 but 2024, and we would need to restate the earnings per share declared for the previous year, it is enough to multiply the stated earnings per share for the previous year with the inverse of bonus fraction. I don't know if this is written in the slides, no, so please write it down, you will need it for the exercises. The importance of bonus factor or bonus fraction over here is not the idea that we just use that to calculate this amount of shares. This is also easily thought of as we did, but we can use the inverse of bonus factor. The inverse of bonus factor, it is 3 to 4. The bonus fraction itself is 4 to 3. The inverse is 3 to 4, okay? How we use that? To restate the earnings per share for the previous year. Remember that the IS 33 requires us to go to the earliest period reported. For the previous year, we already have reported financial statements. We have calculated earnings per share. We have reported 1 year ago, but now I have to restate that amount. And how do we do that? By simply multiplying, and this is the practical use and value of bonus fraction, we simply take the earning per share of the previous year and multiply with the inverse bonus fraction. And you are there. You have calculated the new value of earning per share to declare right now in this period. Did you get that? I noticed that it's not in the slides. It is, of course, in the material, in the textbook, and also we will use it in the questions of the tutorial related to earnings per share. So please keep this in mind. The real use, the real value of bonus fraction is not only to calculate the weighted average number of shares for the current year. That is easily thought of. I issue some shares, let's take that back to the beginning, that's the number of shares for this year. But I use the inverse bonus fraction to restate the earning per share of the previous year. Okay.
And what about the capitalization for shares?
Sorry?
If we have this kind of situation of capitalization or shares use?
Shared issues?
Yeah, somehow.
This is the case of share issue at no price. This is the bonus issue. You are assuming another type of share issue or?
Oh, the S-Philip case.
Sorry?
The S-Philip case.
I'm afraid I'm not understanding the question. I'm sorry.
Okay.
Uh-huh.
Then we have the bonus issues and
Uh-huh.
capitalization
Yeah.
and the share split.
Share split. Yeah.
So it's applicable to that kind of situations or not?
It is the same thing. I mean, the bonus issue, the stock dividend, or the share split, they assume the same thing. We are increasing the number of the shares without having anything coming in the company. So the bonus issue will have the same treatment as the share split. Although in that case, the bonus fraction will be, again, with the same formula, the number after the share split, because it is a share split in that case, compared to the number before the share split. You will have this fraction that you will use for two things. One, to calculate the weighted average number of shares per current year, and two, the inverse of the fraction, to restate earnings per share for the previous year. Okay? Did you understand the answer? Did you understand the answer that I offered to your colleague? Was I even right or wrong? You didn't pay attention. Again, this is something that is important for you to apply during the exercises. So I'm just raising your awareness and what to remember for the part of the exercises. Now, the rights issue becomes even more complicated, okay? In case of bonus issue, we do not take anything in the company. We are just issuing some new shares and receiving nothing in return. That is share split, stock dividend, capitalization, call it whatever you want. But in case of rights issue, actually you are issuing some shares for a less than market value. That is, you are receiving some money, some resources are coming in the company, but not at the same amount as they would have come in the company if you had been issuing these shares at full market price. That means if I offer this right to you as an existing shareholder and I leave you, I offer you the possibility to purchase the share with 10 cents. Whereas if I offered the same share in the market, I would have taken €1, so 10 times more. That means that the company is offering a right or a priority to purchase the share to the existing shareholders. This would have a negative impact on earnings per share, because otherwise I could have offered the same amount of shares in the market and sold in the market, I would have raised more funds, raised more capital. Instead, I choose to offer them to existing shareholders for less than market value. Okay, so basically what a rights issue does is that it combines some features from the capitalization or the bonus issue, let's say, with a full market price issue. Full market price when I sell the share at a full market price, and bonus when I sold or offered the share at no consideration at all. That means if I offer at a price less than the market price, this has combined features of a bonus issue and a full market price issue. So something in between, let's say. The number of ordinary shares that we use to calculate basic earnings per share is the number of ordinary shares before the issue multiplied by a factor which in case of rights issue is not called bonus factor anymore, but it's called as multiplying factor. It's known with this name. The multiplying factor will be the ratio between fair value per share before the exercise of rights to the theoretical X rights value per share. Again, we will apply a certain fraction or a certain factor. During the rights issue, this factor is not known as bonus factor, but as multiplying factor. And actually, it is the ratio between two prices or two values. In the numerator above this ratio, we put the price or the fair value per share before the exercise of the rights, basically with simple words. Multiplying factor will divide the price of the share before I issue the rights to a theoretical X rights value per share. Now, this is something that we have to explain in more detail. Again, in the multiplying factor, in the numerator above the ratio, we will put the price of the share before we issue the rights. And in the denominator, below the line, we will use this theoretical value. Now, as you may imply, theoretical value is not something that exists in reality. It's something that I calculate for the only purpose to apply to the multiplying factor. So again, theoretical X rights value per share is the theoretical price that the shares would have had if I would have issued them in the market with their price, their market price. Okay? Now, if I may continue to the next slide, is it okay with this one? Again, we use, in order to calculate the weighted average number of shares when we issue rights, we use a factor, but we don't call it bonus factor or bonus fraction. It is known as a multiplying factor. Basically, it's not the ratio between number of shares as before, but it's the ratio between prices of shares. The number above, the numerator, is the price of the share before I issue the rights. So what was the price of the share in the market before I was issuing these rights there? That's easy, that is understandable, right? The only thing that I struggle with, and I need some guidance how to calculate, is this one over here, theoretical X rights value per share. To be more clear, this is the theoretical price that would have existed after I execute the rights issue. So basically, the multiplying factor is the ratio between two prices. Price before and price after. Price before issuing the right and price after issuing the right, okay?
So I can say it's the assumption price.
Yes, it is an assumed price. That's why it's the name theoretical. It's assumed. We are going to explain that now. I mean, the fair value per share before the exercise of rights, with simple words, market price of shares before the rights issue. This is something that you can easily derive from the market and is given as a data in the exercise. In this exercise, it's there, I think it's 25 cents. The market of the price before the rights issue, if I'm not wrong. But what about the theoretical X rights value? This needs a formula to be calculated, and the formula is over here. The theoretical X rights value can be calculated by combining the total market value of the equity before the rights issue, and that is the product between market price per share multiplied by number of shares, plus the proceeds that we are receiving from the rights issue. That is simple, issue price multiplied to the number of the issue shares that we are issuing right now. We add these two amounts together and we divide them by the total number of shares involved together. That is the total number after the rights issue. Again, the theoretical X rights value per share is an assumed price. Assuming everything is going okay, what would be the price of the share after I issue the rights? Okay? So what we basically do is that we sum together the market value or the capitalization value before the rights issue, plus the proceeds, how much money I'm taking from issuing these rights, and all this value we divide by the new number of shares after we are issuing the rights. Again, this is a price that we are trying to calculate. This is not the share price after issuing the right. Why is not the share price in the market? As we told you, the market will have prices estimated by its own rules, expectations of investor, and so on. This is not the price of the market. This is an assumed price that would have been true if the market would have been fully efficient and so, but actually this is a theoretical or an assumed price that we calculate by dividing the total value of our shares with the total number of the shares after we issue the rights. I don't know if you can understand or if that is clear. Again, we have the market share before the rights issue, and that is going to be the numerator of the multiplying factor. The denominator is going to be an assumed price, something that would theoretically exist if the market would be very transparent and follow our own assumption as company. But the market has its own mind, as we know, is an entity for itself. So the theoretical price that we calculate is the ratio between the total value of the shares after the rights issue with the total number of shares after the rights issue. The total number of shares after the rights issue, okay, that's okay. Whereas the total value, it is the capitalization, total number of shares multiplied by the market price before the rights issue, plus the total proceeds. How much money do we get by issuing these rights? The number of shares that are issued multiplied with the issue price, okay? I think that we have like an example, and maybe this is more clear to explain. Relating to the rights issue, we have this example. I apologize for taking off the mask. It seems to me like I'm clear, I can speak clearer when I don't have that, so I apologize again. Explaining the rights issue, we'll have a short example. We have company tax that wants to raise capital and decides to issue to issue 1 share for each 5 outstanding shares, okay? Now, this is not quite a bonus issue because we are not issuing the 1 new share for each 5 outstanding for free. We are issuing them at a price which is lower than the market price. The market price is 25 euro, and we are issuing these new shares at the price of 10 euro per unit, okay? So again, this is not a bonus issue. A bonus issue would have been an issue for free, at no consideration at all. But whenever we issue new shares at a lower than market price, that is a rights issue. And of course, before we sell these new issues in the open market, we first offer them to our existing shareholders. Each one of our existing shareholders that has 5 shares has the right to buy or purchase 1 more with this favorable price that is there. Okay, the 1 to 5 issue takes place on 1st of March, and all shares issued are subscribed. It means that all these shared issues are taken over by somebody. They will be fully issued. It's not the case that some of them are not subscribed and I have to take them to the market, a part of the issue, and I have to sell that with the full market price. All the rights issue is subscribed or is signed by the existing shareholders, okay? It's going or it's expected to be fully executed. The number of outstanding ordinary shares before the issue was 500. Now you can imagine, if I have 500 existing shares, how much more shares will I issue with the rights issue? The ratio is 1 to 5, 1 for each 5. So how many new shares should I issue right now? We have 500. We will issue 100 new shares. Good. The profit for the year 2024 is 1,600 euro, and the profit for the next year is 2,000. So we have 2 years, 2 consecutive years to count for. What we are required for is to calculate the earnings per share for 2024 and 2025. Remember that the rights issue happened in 2025. Relating or referring to the requirements of IAS 33, we have to calculate the earnings per share for 2025, but also to restate the amount of earnings per share for the previous year, 2024. Okay, so the increase in resources of company will take place during the current year, that is 2025, the shares are issued at less than market price. So this means that we have a rights issue combining together a bonus element and an issue at full market value element. Both of them are combined together when we consider a rights issue, usually. First, what we do is that we have to calculate and determine this assumed price, or what we know with through the terminology of this accounting standard. This is known as the theoretical ex-rights value per share. Using that number, we are able to calculate later the multiplying factor. And the multiplying factor will allow us to calculate an accurate and correct number of weighted average shares in issue or outstanding, okay? So the first step is to calculate the theoretical X price, or the assumed price. What would have been the price in the market, being fully efficient, if we may say so, and reflecting the inner characteristics of the firm. What would have been the price after we issue 100 new shares for in the ratio 1 to 5? Okay, to calculate the X theoretical value per share, remember the formula. We have to divide the total value of shares after the right issue to the number of shares after the rights issue, okay? So step by step, let's discuss together. The total value of shares after the rights issue is the sum between market capitalization. Market capitalization is the product between number of shares and their price in the market. Before we issue the right, remember we have 500 shares and their price is 25 euro, right? So the product in the first bracket over here is oftenly referred to as market capitalization. If you hear this word even in your future work, remember, is the total market value of the shares, the product between number of shares and the price, okay? So this is what your, let's say, this is what was the worth or the value of the shares before I issued the rights. Then we issued 100 new shares and we offered them with a value of 10 euro per share. So what are the proceeds from selling this new share? How much money are we getting from selling them to the market? We are getting 100 multiplied by 10, that is 1,000 euro. Again, this is the total value of the shares after issuing the rights. The market capitalization of the existing shares plus what money do I get in from issuing these rights. Is it clear now how we calculate the total value? Good. Now, this total value is applied to the new number of shares after issuing the rights. That means that this total value over here relates to 600 new shares. That is the number of shares after the right. Okay? I can apologize. I think I'm more direct and clear when I don't have an answer. Now you see that the new theoretical X price for shares, it is 22.5. What was the market price before the rights issue? 25, okay? When we issue the rights, usually the market will react. The investors will react to this issue emission, to the rights issue. We don't know how much will actually the current price in the market will be. For sure, it will not be 22.5. The market in the price can be 20, can be 19, can be 15. It depends on how the market reacts. And sometimes the market reacts really very strangely by increasing the price after you issue the rights. Sometimes these companies are considered successful with potential for the future, and investors are willing to pay to have these shares, and the market price will go up. So we don't know the market price after issuing the rights. This is not the market price. This is a theoretical price. This is an assumed price that would be fair to be applied to each of the shares of the company after we are issuing the rights, the 100 new shares. Again, a theoretical assumed price, logically calculated as the ratio between total value of shares and total number of shares. Total value is the market capitalization before issuing the rights, plus the proceeds or the cash that I'm receiving in the company with the issue of these new shares with a lower market value, divided by the new number of shares after rights issue. Is it clear now what the theoretical price is? Again, it's not something that exists in reality. The market price after issuing some rights can be higher, can be lower, that depends on the market expectations. And as we said, the market sometimes has the brain on its own and behaves on its own decisions. So this is what it should be, what it is a fair price to be applied to each of the new shares after issuing the rights. Is it lower than the previous market price? The previous market price is 25 and the theoretical is 22.5. Is it lower? Yes, it is, and normally it should be. Why? Because I'm issuing some shares with a price lower than the normal market price. Okay, so having the theoretical X rights value, now I'm ready to calculate the multiplying factor. Remember that the multiplying factor is the ratio between two prices. The price before the rights issue, that is 25 euro, and the price, theoretical, assumed price after the rights issue, this 22.5. So again, multiplying factor is not the ratio between number of shares as it was in the bonus issue. In the rights issue, the multiplying factor is the ratio between two prices. The price before the rights issue and the price after the rights issue. But as the price after the rights issue can vary in the markets and so on, the standard has introduced a theoretical way to calculate this price after or X post rights issue. Okay, so the multiplying factor, you see that the formula here makes you confused a little bit. Multiplying factor is the ratio between fair value per share immediately before theoretical. Don't be confused by big words. Multiplying factor is simply the ratio between price before and price after. Price before is the market price, price after is the theoretical, as we said that the market could react in various ways. Okay, so multiplying factor is simply the ratio between 25 euro and 22.5. That is, we have a multiplying factor by 1.11. This is the multiplying factor. Any question to that? So it may seem like there are big words attached to the calculation of the multiplying factor, theoretical, X price, and so on. But remember to just reduce it in simple concepts that we already know about the shares and prices and so on. Okay, why is that important? After all, how we use the multiplying factor? We calculate earnings per share for the current year, taking into account the time period, so waiting the issue relating to the time period, but also the multiplying factor. This is very similar now to the bonus issue case. So we divide earnings per share for the current year. We divide the earnings. Earnings are 2,000. Nothing to think or to complicate about that. 2,000 is the earnings. Now, the number of weighted average shares is here in the denominator. Don't be confused by a lot of calculations. It's basically the same stuff that we went and explained even before. We start with 500 shares, which are outstanding for 2 months only, because on 1st of March we are issuing the rights. Okay? So we multiply 500 shares with the weighted period, 2 months to 12 months of the year, but also don't forget the multiplying factor, 1.11, that is here. And then we add the rest of the period, like 10 months. We have 600 shares in issue or outstanding. Okay, this you remember there are two ways to calculate for the weighted number of shares. This is one of the ways. When we calculate the number of shares, it will be 592.5, and the earnings per share for 2025 will be 3.37. So basically, again, earnings per share is the ratio between earnings and weighted number of shares. Now, weighted average number of shares, whenever we have a bonus or rights issue, should take into consideration the time period, but also a factor, either a bonus factor in the bonus issue or a multiplying factor in the rights issue. The multiplying factor is slightly more complicated to calculate, but still, I hope you understood how to do that. Now, how we also use the multiplying factor, remember, we need to restate, we need to recalculate the earnings per share for the previous year, as according to the requirements of IAS 33, to go back and apply retrospectively to the earliest period reported in financial statements. That is, for 2024, we had reported earnings per share 1,600 divided by 500 number of shares, either multiplied by 1.11 or multiplied by the inverse of the multiplying factor. So you see that this factor is important not only for the current year, but especially to restate the amount of the previous year. In the previous year, either you are applying the multiplying factor to increase the number of shares in the denominator of the ratio, or simply, as I mentioned before, take the inverse of the multiplying factor and directly multiply or apply that to the number or the figure of the earnings per share for 2024. Mathematically, it's the same thing, okay? Well, I know that is a lot. Questions?
Yes, second braces, we have to multiply the 600 to 10 fraction with 12, yes? It's a plus.
No, it's not a loss. It's a profit for
Let me
2024.
the equation.
Equation, yes?
Yes, on second braces.
Yes, here?
No, the other one.
1,600.
No, the 600 plus 10 fraction 12.
It's just
It should be multiplied.
You just sum of those numbers. It should be multiplied.
it should be multiplied the ratio, you mean? Or
No,
can you come here and just stop, please? We have a question or suggestion, I will say, from the class. Sorry, after that we will have the break. Okay? Okay. Yes. Thank you. Did you get that? Any of you? Okay. But please feel free. If there is an error, probably you have to tell that. So when I post the final version in Moodle, I will not have made any mistake. We have a short break, 5 minutes, and then we continue. Thank you. Okay. Now, we have so far discussed some technical things about IAS 33. The requirement to use a weighted average number of shares that makes us ponder or weight the number of shares to the period that they have been in issue or outstanding. That was the first thing. Then we discussed two examples when we issue shares either at no consideration, no price, it was a bonus issue, or when we issue new shares with a less than market price, that is a rights issue. In both cases, we need to weigh the number of shares not only with the period when they are outstanding, but also to what is known as a factor or a fraction. In case of bonuses, that is the bonus fraction, simply the ratio between the number of shares before and after issuing the bonus. Whereas in case of rights issue, things are a little bit more complicated. We calculate the ratio or the fraction, known as multiplying factor, as the ratio between two prices, the price of the market before and after. Whereas after should be a theoretical price, and we take some detailed steps of calculating a theoretical price by combining the total value of shares after the rights issue to the total number of shares after the rights issue. Well, the most technical thing to discuss over is the diluted earnings per share. That is, how to take into consideration not only issuing rights and bonuses, but what if some of the shares that are currently in issue or outstanding have dilutive features? That is, there are potential ordinary shares. That would require me to calculate, besides basic earning per share, also the diluted earning per share. How do I do that? So let's first go over what the standard requires. As we said, when we have securities that are at your end, and they will probably have a claim in the future on the equity, then we have to calculate the dilutive effect. This is done actually by recalculating the basic earnings per share, by taking into consideration the dilutive effect of each of the classes of the potentially ordinary shares, because we may have more than one of them at a certain time. Diluted earnings per share, for the calculation we start with the same earnings amount that we have used in the basic earnings per share, but first we have to adjust this earnings amount with the after-tax effect of for example, whatever the potential ordinary share is implying or means. If we have any dividends or other items that are related to diluted potential ordinary shares, they are deducted to arrive to a profit or loss that is attributable or is available to common shareholders. And this is in accordance with the calculations that we have previously done for the case or for the sake of the basic earnings per share. In case we have any interest that is recognized in the period that is related to dilutive potential ordinary shares, and also if we are having any other changes in income or expenditure that would result from the conversion of the dilutive potential ordinary shares. Okay, that was technical stuff about calculating diluted earnings per share. What we have represented in these slides over here, it is the requirement of disclosing the basic earnings per share and diluted one on the financial statement. Again, the example is extracted from the financial statements of the PCA group. At the right of the bottom of the performance statement, you can see here that the company, after the consolidated profit loss for the period, which part is attributable to owners and which part is attributable to the non-controlling interest. Then we have the calculations of basic earnings per share, the first two lines over here, and then the diluted earnings per share. Of course, you can see another requirement that in case we calculate basic and diluted earnings per share, we should do so for both continuing and discontinuing operations. You know why it is important to make the disclosure for both lines of operations. And the company has done the same. Actually, you see no change in the figures because there are no discontinuing operations. And therefore, the two lines of the basic earnings per share have the same figure among them, and so the diluted earnings per share. Also, notice something else. The diluted earnings per share is lower than the basic earnings per share, and hence the meaning of the name. We take into account the potential dilutive effect of certain securities, and therefore we expect that the DEPC is lower than the basic one. Actually, the standard declares that in case you have potential ordinary share that actually increase the value of the earnings per share, you will not take them into account. So what you will take actually into account is only the dilutive effect, not the anti-dilutive effect, okay? So almost always you will find diluted earnings per share lower than the basic one. Okay? Also, except for the bottom of the performance statement or statement of performance, where we find included as required required by S33 the figures of basic and diluted earnings per share. We also have the notes of the financial statement where basically the company has disclosed how they calculated the basic and diluted earnings per share. Now here, note A, calculation of basic earnings per share. Basically it is very similar to what we did, but with actual real figures for a real company. They take into account the earnings, the figure of earnings. Then they divide that with the average number of shares outstanding. They do not disclose the calculations for arriving at this weighted average number of shares, of course, but it implies that they follow the standard because they usually disclose this in their statements. And here we have the basic earnings per share for each of the year. Also, the calculation of diluted earnings per share is included there. You see that the number or the amount of the earnings does not change. What is changing in this case, it is the number of the equity shares that are potentially converted in the future. And there are two items that the company is mentioning. Equity warrants delivered to General Motor Group. This is the amount in 2020. And the performance share grants. What do they mean? If we are not very clear by the name, we can jump at note 8 to A over here and we can look for ourselves what the company implies with the performance share grant, but basically it's a bonus element to the managers and employees. In case they have been performing above some criteria, they will be given some grants that they can later convert to common shares. Now, when we take into account the calculation of diluted earnings per share, the company required, as from the IS33, will assume that all of them will be converted into shares. So we are not assuming that maybe some will and some will not, but we consider like every one of these security, each one of them will be converted to ordinary shares in the future, okay? So this is like the view from a real financial statement, what we expect to find about the earnings per share and also in the notes. Expect to include something similar in the presentation of your work project groups. Regarding the earnings per share for each of your companies, you will show in the slides exactly the same probably, how the company has disclosed the information and what is in the notes about calculating both figures. Of course, this is something that the company has done, has prepared. I will not require you to calculate the basic earnings per share for your companies, but just to understand how the calculations have been performed, okay? Well, we have some other, I think some other examples over here. This is relating to the calculations of the diluted earnings per share in case we have some preference dividends. Again, these are examples included in the textbook, and that's why they are included in the slides and shown. Of course, the solution is shown there. Later on, we'll see something similar, as we said. The first example related to the calculation of diluted earnings per share has this information. We start with the profit before taxation, 1 million. We take out the taxation, including the deferred adjustment, that is 400,000. The profit after taxes is 600,000. Of course, we apply the dividend, preference dividend and ordinary dividend, and then we have the net earnings for the period, 450,000. Remember, this is similar and actually the same illustration that we took at the beginning of this lecture today, this morning. So, other data is that we have 2 million ordinary shares outstanding, and in addition to these 2 million ordinary shares, there exists some convertible loan stock of 500,000 euro, which bears interest at 10%. Convertible loan stock means that whenever the time may be deemed right by the loan stockholder, they can convert this loan stock into common stock, common share, okay? with a ratio that is explained there. This may be converted into ordinary shares between this date and this date, 2023-2026, at a rate of 1 ordinary share for every €2 of loan stock. It depends on how much loan stock you have purchased as a creditor, but you, in any time between 2023 and 2026, can convert that into common stock, with this ratio, 1 share for €2 loan stock. That means that in total, if everybody does that, if all of the creditors take this decision, €500,000 of loan stock in total would be converted into 250,000 new shares, okay? So the ratio 1 new share for €2 loan stock gives us this conversion with these figures that we have over there. Okay, the corporation tax is assumed 50% just for simplicity reasons, for convenience, and we are required to calculate the fully diluted earnings per share. The standard requires us to start from the same basis as which we took into consideration for basic earnings per share. So basically, I would take earnings, I would take the number of shares, and then I would consider the effect of this security that has potential dilutive effects. Okay, what we can do in this case, I think you have the solution in your slides, and we'll explain that step by step. As we said before, considering the conversion of loan stock, we will have 250,000 new shares issued whenever the conversion will take place in the future. But not only the number of shares will change, not only the denominator in the formula, but also the amount of the earnings. And this is to think very carefully about that. The amount of earnings, which is the numerator in the earnings per share figure, will change because in case we have the conversion of loan to stock, I will not have any more interest rate expenditure, okay? In case this loan is converted into stock and shares, later I will not have to pay interest on the loan stock. I will have to give dividends to common shareholders, but dividends are not expenditure. They are distribution of profits, as you remember. So, having this conversion, if this conversion takes place, I will have a higher earning figure, okay? Because I will not pay any more interest. Of course, I will have to take into consideration the after-tax effect, that is applying the tax rate, which is the real impact in the financial statements of the company. That is, the interest of 10% on the amount of the loan. Actually, the interest expenditure is $50,000, okay? But after the tax effect will be only $25,000. Do you get this calculation, or I need to go into details about that? Remember that the interest expenditure is deductible before the taxes. That means that the after-tax effect of each of the expenditure that is deducted in the income statement prior to the taxation figure should be adjusted, should be converted into an after-tax effect. Every expenditure that you pay and is deductible, tax allowed, you should adjust, you should convert to an after-tax rate. Why do you do that? We say that we should do that, but what is the reason? Why do we do that? For the for the expense deductible. Anyone has any idea why we should take into account the after-tax effect only? Assume something. Whenever you have an expenditure or an expense that is deductible before taxes, that means that practically a part of that expenditure is paid by the government, allowing for you to deduct this expense before applying the taxation rate. That means that part of that expenditure is really paid by the state, by the government. That means that whenever you are deducting an expenditure after the taxation, that is not tax deductible, and you are not having any benefit from that spending or that expenditure, I mean. So every time one expenditure is deductible before taxes, that is like a tax relief for companies, because part of that expenditure is actually being paid by the state by allowing you to deduct that amount of expenditure before applying the tax rate. That means that even though you are paying 50,000 euro to these loan creditors, because you are deducting the expense before applying the tax rate, this means that actually your real effect is only 25,000 euro. The other part is actually not paid by you at all. It's not paid by the government, but this means that you are paying less taxes. And this is included as a benefit. Okay, if you want more to be discussed about this, we can discuss later, but actually every time you have to adjust the amount of expenditure on a tax basis rate, you have to take into account the tax deduction, okay? So keep this in mind. And if I may explain in another way, whenever you have the profit statement, you know that you have the taxes line as a line division between two important parts. The part before the taxes is everything that is tax deductible or tax allowable. And everything that you have after the taxes is not tax deductible. For example, the other comprehensive income that we discussed 2 days ago. Now, everything or every calculation that you need to do in the profit statement that involves two items that are divided by the tax line, you have to adjust to bring them into the same basis. That means that you cannot add the profit after taxes to one expenditure which is before taxes. That would be like adding together apples and pears or apples and bananas. They do not have the same basis of valuation, if you know what I mean. So again, when you are trying to add together the earnings that are after taxes with an expenditure before taxes, you have to take that expenditure and apply the tax effect in order to bring them to the same basis of valuation and add them together. Otherwise, it would be like adding together, as I said, two different things that cannot be added, like grapes and apples. No connection at all. How would you measure that? So you have to bring them into the same basis of calculation. That's why you take into effect the tax rate whenever you have to do calculations like this. Earnings after taxes. Interest expenditure before taxes. Then apply the tax adjustments. That is the reason behind this. Okay. So after we take into account for taxes, the earnings will increase. The previous earnings will increase by 25,000. That is the after-tax effect of increases in earnings because we are paying less interest on the loan stock. That is the amount of earnings will be 625 already. Of course, always deduct the preferred dividend. The preferred dividend is 50,000. This PD here is preferred dividend. Then you have to divide the amount of the adjusted earnings, adjusted taking into account the interest after taxes. You have to divide that with the new number of shares, which is 2 million shares plus 250,000 new shares that you are getting from converting from loan stock to new shares. So you can see that the diluted earnings per share right now is 25.6. Is that clear how this is calculated, or should we go over that again? What do you think? Can we continue? Okay. Another example to cover the diluted earnings per share actually is the case when we don't have loan stock. I think we have share options. And converting them to real shares maybe does not involve taxes or after taxes effects. Let's see. We have a company that realized 600,000 in profit. This amount is attributable or available to ordinary shareholders. So this is the amount of the earnings that I should use in the calculation of basic earnings per share. In the year 2026, we have 300,000 shares that are outstanding. The basic earnings per share for company is €2, and that is easily calculated as the ratio between the earnings amount, 600,000, and the number of shares, okay? But during this year, we also have 100,000 share options. You remember what options are? We discussed in the previous hours. Options give the potential to the holder to convert in ordinary shares in case the execution price is lower than the market price. Now, the execution or the exercise price is 10 euro per share. And you see that the market price of the shares is 15 euro. I think if you were in the place of these option holders, you would execute the options, you would exercise these options, because you can buy a share which is priced at 15 euro, you can buy that for 10 euro. You'd take the opportunity, right? So we have to assume that other option holders would do the same. They will exercise these share options. And we will have 100,000 new shares more. Now the calculations are represented in a table. Let's follow the calculations together here. The profit for ordinary shareholders is 600,000 euro, as you can see here, whereas the number of shares is 300, and we have the basic earnings per share calculated even in the previous slide, equal with 2. Now we take into account the dilutive effects that affect both earnings and number of shares. First, what is the effect in the number of shares? Now we add 100,000 new shares more. As these 100,000 new shares have been executed at or have been exercised at a price which is below the market price, we are taking into account a number that is known as inferred shares, or inferred shares actually is the term used in the IS 33. But you can recognize them as assumed shares, shares that would have been issued if I would follow the regular price in the market. How do I calculate the number of the assumed shares or the inferred shares? Look carefully here. We have issued 100,000 shares for 10 euro each. That is, we have collected 1 million euro. If we divide this amount of money, 1 million euro, to the regular price of the market, which is 15 euro, we would have issued only 66,000, well, this is a strange number with many sixes, but we would have issued this amount of shares to generate the same amount of money, 1 million euro. So, I'm issuing again, I'm repeating. I'm raising 1 million euro by selling 100,000 options at 10 euro each, okay? This is the contract that I have these option holders. It would have been the same amount of money that it would have been generated if I would have sold by the regular market price, 15 euro, this amount of money. So actually I have not issued 66,666. This is an assumed number of shares. This is an inferred number of shares, but this would have been issued if I had followed the regular price of the market. Instead, I followed a lower price, which is 10 euro, and I raised or provided the same amount of money. Do you get the notion of the inferred shares in case of options? Or do I need to explain that again? So in order to calculate the weighted average number of shares, we do not take into account 100,000 options. Why? Because as in the case of the rights issue, they have been issued with a lower price, so I have to take into account some factor of multiplying or adjusting. We do something else here, which is even more simpler. We follow the calculation of a number of inferred shares. The number of shares that I would have issued to generate or raise the same amount of money if I had followed the capital stock market price. Okay? Again, how it is calculated. Divide the proceeds from sale of options to the regular price market, and you have the number of inferred shares. Now, if we add together the weighted average number of shares with the actual increase, the real increase in the number of shares, which is 100,000 less 66, we would have the new weighted average number of shares equal to 334. Then the diluted earning per share is 1.74 altogether. Any question? Okay.
Will we have to time weight also the shares under option?
No, in the diluted earnings per share, we do not have to wait for the time period because we will assume that this will happen since the beginning of the earliest period in question. So we start calculations from 1st of January. This is why we don't take into account the time period. Okay? Questions? Other questions here? Okay. Again, some clarifications about the requirement of IAS 33 related to the retrospective adjustments. I continuously mention this requirement, so I'm just continuing. The importance of earnings per share, again, as a reminder. Something that I mentioned and I have to remind you again. In case there are any discontinuing operations, we have to disclose two earnings per share figure. We saw this in the statements of PCA Group. You saw there were for continuing and discontinuing operations, both basic and diluted earnings per share. Okay, there are some test questions. Basically, not very difficult. So, for the answer of the first question, answer D is the correct one. So, option 4. For 2018, we will have the amount of basic earning per share 2.1 and the restated amount to account for the stock split, it is $1 per share. I'm going through them fast if you allow in order to have some time for the Excel illustration. Okay. 2018 earnings per share are 2.1. No, nothing to think or double think about that. We are over here. Whereas in 2017, we reported earnings per share $2 for 10,000 shares, but now we've had a stock split. Okay? So we have to restate the amount for the previous year. How can we restate that? Remember the inverse of the bonus fraction? The bonus fraction now is 2 to 1. The inverse is 1 to 2. That means that I have to multiply the previous earnings per share 2 multiplied by 1 to 2. That is 1. Okay? Not okay. Again, bonus, you remember bonus fraction. And this is a bonus issue or a stock split is the same thing. A bonus fraction was the ratio between the number of shares before compared to the number of shares prior after the bonus issue. And the inverse of this bonus fraction, which is 2 to 1, would be applied to restate the earnings per share for the previous period. We used to have a $2 per share reported in the previous period. That is, if we multiply that with the inverse, which is 1 to 2, we would have a figure of earnings per share equal to $1 over here. Okay, let's have another test question. Again, these are multiple test questions, but require you to do a minimum amount of calculations beside that. We have a company that has reported the following: ending market price, earnings per share, basic and diluted, and the dividends per share. Price earnings ratio, you remember that the price earnings ratio is basically the ratio between the price in the market, this is the price in the market over here, the first line, divided by the basic earnings per share, not the diluted one. So this means that the correct price earnings per share, sorry, the diluted, is the alternative A. The ratio between the market price ending one and the diluted earnings per share. Okay, another test question. Again, this is something theoretical. It doesn't require you to do any minimum amount of calculation. Which of the following ratios usually reflects investors' opinions about the prospects for the firm? We emphasized that several times this morning. Dividend yield, book value per share, price earnings, earnings per share, dividend payout. Among all of them, the only ratio that includes the perception of the market is price earnings, because it includes the price of the share in the market. The other ratio, dividend yield, book value per share, they are mainly based in the accounting values or the financial statement items. And they are not reflecting anything about the market prospects or the market expectations. So the only ratio that tells something about this, even though it is not perfect, it has its own pitfalls and it's faulty sometimes, we explain that, even though it is sometimes it has disadvantages, it's the only ratio that tells something, says something about the prospects of the firm in the market. Another test question over here, indicate the effect of each of the following transactions on the earnings per share. This is similar to the one question that we did yesterday in the tutorial. We had some transactions, but we saw their effect on the net income and cash flows from operations. It's basically the same kind of question, but right now we have to take into account transactions and how they impact the earnings per share. Remember, earnings per share is the ratio between earnings or profit that is available to common shareholders divided by the number of shares. If this transaction affects one or both of these two elements, it will have an effect on the earnings per share, okay? So company issued the stock dividend. Will it affect the earnings per share? If it will be increased plus, decreased minus, or zero for no effect? What do you think? This is something that we already discussed today, okay? So it shouldn't be difficult. Company issued a stock dividend. This means that this is a bonus issue. If we have a bonus issue, do the earnings change? No. Do the number of shares change? Yes, of course. So because we have issued the stock dividend, the earnings per share will decline, will decrease, minus there to represent the effect of this transaction again, okay? So this is the way you should think for every of the events or transaction. Collection of accounts receivable. Does that have any impact on the earnings? No. Does it change the number of shares? No. No effect at all. Sale of products. Does that affect the amount of earnings? Yes. Of course. Okay, I have more revenue, more earnings, good. Does not affect the amount of the number of the shares, so increase in the earnings per share. Number 4, buying trading securities as short-term investments. A common transaction for many companies that does not affect the earnings. It will affect later when probably I will sell them at a gain or a loss, but this will happen later as we assumed we are going to take into consideration only the immediate effect of this transaction only, not what it will bring for us in the future. So for the moment, it doesn't affect the earnings, it doesn't affect the number of shares, so the earnings per share will not be affected by all transactions. Okay, you see that it will be affected only from those events that will change the earnings through revenue or expenditure, or will change the number of shares. Okay, good. Here are the answers for whatever we covered before. Good. Now I think I have indicated the following statements are either true or false. The price-earnings ratio expresses the relationship between selling prices of the company's products and the related earnings. Okay, that is completely false, obviously false. Yes, it is, even it is in the next slide. Okay, here it is. In computing earnings per share, preferred dividends are deducted from net income. That is true. Remember that when we calculate earnings per share, the amount of earnings that we take into account in the numerator of the formula is actually the earnings that is available to common shareholders. Okay? I have to answer to Ivan. Yes, Ivan, that is true. On the Moodle, there are no answers because I intended to use these test questions to test your attention. So this is why you don't have answers, but I think that you can write down the answers right now that we are going over them. You are welcome. So the intention is to make us think now, instead of the readily solutions that we had in the previous slides. Okay. Another test question as well. Obviously, we have no time to go through the Excel illustration today, but still we have added one tutorial session for the next week, and we will use for Monday. We will use the extra tutorial session on Monday to cover the remaining cash flow statement exercise and what we couldn't cover today. I think that it is better than forcing ourselves now that we are tired to go through Excel that would otherwise take many more minutes if we are left. So again, we have this company, net income is 1 million. There were 1 million shares outstanding as well. On 1st of July, the company issued 100,000 new shares for this price. The company paid 200,000 in dividends to common shareholders. What is the basic earnings per share? Remember, the payment of the dividend to common shareholders does not mean that I have to deduct that amount from the amount of earnings. Still, net income, 1 million, is the amount of earnings that I will use for calculating basic earnings per share. I deduct only the amount of preferred dividend, not ordinary dividend. Okay? So something to say about that. And also, we have an issue in the middle of the year, in 1st of July. That means that I have to calculate the weighted average number of shares. We start with 1 million shares. They are outstanding for 6 months. And then for the next 6 months, we have outstanding 1,100,000. There are two possible ways to calculate the weighted average. Now, let's go where we have shown the calculations as well. So the numerator, it will be the net income, as I explained. Be careful, even though you have the dividends to common shareholders here, it doesn't mean that you have to deduct that. You have to take it into account only if it is the preferred dividend, remember, okay? Whereas the denominator, the number of shares, I follow this way of calculating. You can follow either one. It will give you the same result. So it is 1 million shares. They are from the beginning to the end of the year. These 1 million shares are outstanding. They are not changing. They are there. Whereas the new shares that I'm issuing at 1st of July, 100,000, they are outstanding for only 6 months out of 12 months of the year. Okay? So if we apply all these calculations, we find that the number of shares is 1,050,000 shares. Which is the other way to calculate the weighted average number of shares? Just to have, which is the other way to calculate them? It would be 1 million shares are outstanding for 6 months, whereas 1,100,000 are outstanding for 6 other months. If you again do the calculation, it will give you the same result. What I'm trying to say is you can get confused which one to use. They are both valid. Okay? Good. So I don't know if this is the last one. It relates to the options. Remember that calculating the diluted earnings per share in case we issue some options, it is a little bit complicated because we have to calculate the inferred shares. And out of the number of options, we have to deduct the inferred shares to be left with a real increase in the number of shares after the option conversion or the option exercise. So we have this company sells services. They have 1 million average shares outstanding during the current year. They also have 10,000 options outstanding, and these options have an exercise price of 10. Okay, is this the same? I think this is the same. This is the same question related to the same data as before, so it should be easy to understand. It is the same question related to the same exercise that we solved before, right? So how do we do the calculations? 10,000 options are executed with $10. That means that we have proceedings, okay? We have proceedings, $100,000. Had they been issued at market price, it would have been 6,667 inferred shares, referring to the terminology required by IAS 33. That would have been the number of shares I would have issued if I had followed the market prices. Actually, I have issued 10,000 shares. I would have issued only 6,000 and something. The difference between them is the real increase in number of shares, okay? This is the number of shares that I have to take into consideration as dilutive, potentially ordinary shares, okay? Do I need to go over that again? What do you think? So it is a little bit more, it's slightly more complicated in case of options. You have to think in the certain approach that we also use to tackle the rights issue. This means that if we are issuing something at a price below the regular market price, this means that we are missing something. Whenever we give an option or a right to someone to buy a share or to exercise an option with a price lower than the market, the company is losing something, and we have to calculate this assumed loss. In this case, these are the inferred shares, okay? So how many shares would I have issued actually in case I had followed the regular price? And generating $100,000, it means that I would have issued only 6,667 actually shares or stock. Actually, I've issued more. This more above the normal number of shares that I would have issued under normal conditions, these 3,334 more shares, these have the dilutive effect. They bear the dilutive potential. Okay? I hope that is clear. But yet, you can go over that again. We'll have the chance to look again at exercises from earnings per share. We'll have a tutorial only for these exercises. I will upload the exercises maybe this afternoon, and you can have a look, but we will not cover the exercises for earnings per share until probably Friday next week. So you have time to read and go over all the theoretical things, and you can also ask questions if you are not clear until it is time to go over these exercises in the tutorial, okay? For group presentation, I think it is clear what you need to do. Any questions? Sorry? Gracias.
Yeah.
Any question you might have? Okay. Have a nice weekend. See you on Monday morning online, and we'll continue with our program. Bye. What happened to your meeting?
I just covered it on.
你要问老师问题吗？那这个地方是吧？这一块啥意思啊？好，
就是比如说你从贷转到 share 的时候，你不是本来不是你手上有债吗？你把债换成 share。 这个时候债本来你像今年要，
Don't forget to have the slides from the
但是不用付了，因为你
we
把
are
它还
thinking
清
about
了，
it.
所以这算是你利益嘛，你就不用付钱了，你就留到你身上的钱。
OK， 那所
然
以
后这个就是要收50%的 tax。
哎，那这个是跟这个是相关联的吗？
对对对，这俩是一个。
OK
然后
OK。
所以这个债月50%是你的利益，50%付利息。
OK，
然后那个50%你是利息拿掉的话，就剩下的就是你自己剩下的就是换掉的，剩下的债的利息的。
OK， 明白了。
我操！
它经常出现哪个？
啊，来了都来了。我就说总感觉他好像穿过来。
然后就经常有这个单词，这个单词是啥意思
Outstanding 是现在呈现现在有的东西
啊？
就比如说公司现在目前有多少这个 Outstanding 是呈现的
呈现的意思。OK。还有一个这个，这个答案是啥呀？这个是答案是老师刚说的那个。
这个我也没听到。下去你问一下他们，
问一下谢谢。谢谢。这个当时老师说是哪个答案呀？第四个。
对，就是第四
这是第几个 class？
第一个，因为他后来把两个合成一个之后嘛，你17年的那个你就要把它改一下嘛，因为我们每一次是公布2年的这个东西，你18年改了之后，你要把17年的相当于重新订正一下，纠正一下，你就变成了总共是20千，就是2万嘛，但是你现在是有2000个那个 shares， 所以你还是这个总数是不变的，所以你现在每一股只值1块钱，因为他现在不是把2个变成，就2个合成1个了吗？就是就是一个分成2个了嘛，对，1变2了之后，对。
但是它不是2.1块吗？
不，你18年是2块1，你现在只是要订正你2017年的你之前旧的那个数，对，所以你总数还是2万，但是你现在的股数变多了，变成了2万股，所以你一除的话就变成。
它就是总量是不变的。
对。
我们是算2017年的。
不是算，你是要订正它，因为你18年的那个，你把它2股合成1股了之后，1股对，然后你要把17年的那个旧的那个要改过来，不然的话你不支撑。他不是说一般公司就是会每次公布2个东西，对，每次都公布2个，所以你公布了。
那个计算题我感觉我没有太听懂，就这个。
就是那个有一个是乘以1.11那个是吗？
对。
他那个好像也是那个类似于就像天天说的要更正一下。
对，
就是你要更正。